Hello, Troy White, Hoodoo Financial. I'm a portfolio manager and financial planner. Hey, what I want to talk about today is tax planning strategies as we approach tax season. Matter of fact, reach out to me if you need your taxes done by someone who knows how to get you more money back. Don't go to those little fast food joints that do taxes. They just prey on the citizens who don't know how to do their own taxes, and they get you in, get you out. And but anyway, hit like, please, share this video, and subscribe if this is on YouTube. So again, we're talking tax planning strategies for the upcoming tax season. I got a little bit of notes right here. So first thing I want to talk about is retirement accounts and how that plays in. You need to take advantage of your retirement accounts. They help you in a major way, in more than one way. And so we're going to talk a little bit about that. So first off, your 401ks. So your 401k, the amount that you contribute to the 401k reduces your taxable income. What does that mean? So you can contribute, I believe it's $18,500 into a 401k that can be tax deferred. And so what that means is the amount of money that you put in there comes from your paycheck. So the government will defer taxing you on that portion of your income. So just for round numbers, let's say you make $50,000 a year. Then you contributed $10,000 total over the year into your 401k. Then you will not be taxed on $50,000 worth of income. You will be taxed on $40,000 worth of income because the amount that you are investing in your retirement account is tax deferred. The government will defer to taxing that account. So the way that helps you double is that while that money is in there in your account, first off, it encourages you to invest. So that's really the reason the government does this. So it encourages you to invest, and because you probably otherwise wouldn't do it. So in addition to that, that money that is being tax deferred, including the growth, is growing without taxes. So that's, if it was being taxed, it would be less money invested in the first place. It wouldn't be 10,000, it'd be something like, 7,000. And so then whatever gains are made on that are continuously invested. So let's say that 7,000 earned 3,000. So now that those earnings continue to grow tax deferred. So otherwise, if you made that money and you pulled it out and you spending it, then that's capital gains tax. It's going to be a tax on that money. So that money is money that otherwise is going to be taxed and portions of it taken from you. So you actually are paying yourself more by investing in your own future. That's the purpose of 401ks. So it's not just 401ks, 403bs, depending on if you work for a government agency or some sort of teacher or something like that. You can have 403b or 457. These numbers like 401k, 403b, 457, those are literally sections of the tax code. So like 401 is section 401 item K. So 401k, that's all it is. So with these accounts that you can open at my firm, you can come to us and we will help you open these accounts. So when we're doing your taxes, I can open an account as well. So, but what that means is these type of accounts, you put the money in and now you qualify for the tax benefit that is on the tax code listed as 403 item number K. That's all that means, but it's an account that allows you to do that. And we have the infrastructure, all investment firms have the infrastructure to keep accurate records for the tax purposes, to report the tax and to allow you to take that tax benefit. So also IRAs, same thing, is a tax deferred account. Now, another play is the Roth IRA. The Roth IRA is a tax-free investing. So, but this is with after-tax dollars. So this is money that's already been taxed and then put in your pocket. And so now you can put that into a Roth IRA, and whatever it makes from then on is not taxed. However, you can't get the money out until retirement. So, I mean, you can, but you'll be taxed and penalized on the money. So and also simple IRAs. Simple IRAs are for self-employed people, and a simple IRA you can invest. I think it's 12,500, I believe, that you can put in there. And there are other type of tax savings accounts, investment accounts, but fundamentally those are the key ones that you need to be aware of. If you needed to get more in depth, we would sit there and talk about it, but fundamentally those are all you need. Also, health savings accounts, get those if you qualify. It definitely helps you in terms of your taxes, because the amount that you invest in, you're not investing really, you're putting it into your health savings accounts, savings. And those dollars are used for tax purposes. For your health care purposes. So it's you saving pre-tax income, and when you withdraw the funds, you have to withdraw them for a medical purpose. So, you're not being taxed on the monies that you put in there. So it's a smaller amount, but it's another way to make a tax advantage way to tuck some money for tax purposes. And distributions are tax free. So when you take the money out for the healthcare reasons, it's tax free. Some others I made notes here I'm not going to talk about. And so now, if you have kids, and this is getting kind of sophisticated here, charitable donations. Now, every person can donate $12,000 a year to an individual, and there's a cap. That number might be higher now, but there's a cap over a lifetime. It's like $1 million something, 2 million, something like that you can contribute in total, right? But those amounts that you donate, especially helps if you're donating stock. So if you have stock that is losing, but you don't feel that it's going to, you still feel confident about this stock and that it might go up in the future, this is ideal to donate the stock. And so you say, why would I donate stock? I'm not saying donate it to a bum on the street. I'm saying donate it to someone a family member or something. So specifically your kid, donate it to your kid's account. And this strategy works that it can increase the value, since if you donate, you have decreased in value. The stock that's decreased in value since the time you purchased it, then you would be able to deduct the lower market value. So it's a twist to it, but it's a benefit for you to donate. And so then I was mentioning the kids. Now, if you have a way to employ your kids, that's a good play too, because instead of giving money to them, hire them to work for you. So the first 12,000 is tax free for an employee child, and that's part of the new standard deductions that are in place now. That's one of the things in there. So, so if you was to hire your kid and pay them 12,000, then that's tax free. So, and their wage is also serves as a business tax deduction for you as well, which lowers your taxable income again. So remember, the one of the key factors is to lower your taxable income. So if you make 100,000 and you contributed the whole maximum to your 401k, say 18,500, then now you didn't make 100,000. You made 87,050 is what I'm thinking what it is. So then other ways that you can reduce that, like this one, another 12,000 that you pay to your child who is now an employee of yours. Well, that's 12,000 that reduces it further. So the whole name of the game is to reduce your taxable income. What does that mean? The income that you made that is taxable, the amount that the government is saying, hey, I want a tax, I want a piece of that. We want to reduce the amount that they get a piece of. So, and as you reduce your taxable income, that will potentially reduce your tax bracket. Your tax bracket, the brackets are the percentages, and those are based on the amounts of money you make. So the more you make, the higher your bracket. So it's regressive. So, or they call it progressive, one of them, progressive tax rate, right? So the rates are reduced. So if we can reduce your taxable income, then we can reduce the percentage that you being taxed. So let's just, from round hypothetical numbers, let's say you make 100,000, and let's say that tax bracket is a 30% tax. So that means 100 times 0.30. That's your tax, right? Well, if we could reduce your taxable income down to 80,000, well, and I'm certain these are not the brackets, so don't hold me to this. I don't keep them in my head like that. I'll just look it up. So let's say we reduce your income, your taxable income down to 80,000, then that means that, let's say hypothetically, that reduce your tax bracket down to 25%. So now, not only did we decrease the amount being taxed, we decreased the rate that amount is being taxed. Result, you paying less tax. All right. So donate some of your investments. And there's a strategy to that we'll have to dig into a little deeper. And hire your kids. And speaking of that, you should be, then you say, well, I can't hire my kid. I don't have a business. Well, the purpose of a tax planning, when you're talking to me, when you're working with me in tax planning and tax preparation, my goal for you is to start a business, because your tax life is different than as a business owner than your civilian life, your regular employee life, because of the amount of deductions that you can take as a business expense. So fundamentally, we should start a business. And I'm not saying you have to be, Acme, car rentals, or, Acme construction, whatever. I'm saying you need the business to be whatever you want the business to be. You need to start it today. So we need to start it as part of our planning for your tax return. So in doing so, if you had money on somewhere enough to hire your kid, then we should hire your kid. And then it's a side note as well. The reason you also want to hire your kid is because we want to earn money for your kids. So let's just say hypothetically, you have a business. There's social media advertising and print and other forms of advertising where you could just hire your kid as a model or part of your marketing campaign for your company, whatever your company is. You might make donuts, you might have a coffee stand, it don't matter. Well, put your kid in all the pictures. Advertise with your kid. Well, now that's a real thing that they deserve to be paid for. And in doing so, they earned this income. Now, while I was saying that's a benefit, let's say they earn some income and you can, at a certain level, then you can open an IRA for their kid, for your kid. Now, let's say they start making tax deferred income into their retirement account that they starting as a youth. And over time, this is going to be maximized. Let's say we're making the right investments inside that account with the few G's up to 12,000 that you put. And let's just say hypothetically you was able to put 5 G's, pay them $5,000, and you can put some of that into their retirement account. And so over time, that is going to accumulate. And even if you didn't put it in the retirement account, you just put it in a regular investment account for them, and that you created. And this will be a custodial account. Well, they're going to need that money for college and after college. And then let's take it a step further. Let's say you've done that for 5 years going. 5 times 5 is 25, plus the gains that we were making off the investments inside that account. So let's say we turned that 25,000 into 35, to say simple, something simple like that. Just say 30, 35, could be 40, 50 or more thousand. But let's just say, for simplistic argument, you've invested 25,000 total in, or you have paid your kid $25,000 over 5 years. And that kid has invested that $25,000 through you into their own account, into a regular custodial account. Now, that 25,000 has now turned, with the investments, good investments that we made, has now turned into $30,000. Just say something simple like that. Okay, well, what if once they hit college, you use that $30,000 as a down payment on a piece of property that's cash flowing and is sending income to their account. So let's say the $30,000 down payment on a property, they could get a 3% down, first time home buyer property on a fourplex that they get to live in rent free, and it can income. Or let's say they living on campus and they making a G a month now. They can keep stacking that G into that account. And now at this young age, they have a piece of property that's going to constantly pay them this money. So that is going to grow, and then you can use the same trick. There's more to it, obviously, but so that's not what this video is about. But there's more to it. But then you can take that, advance the strategy, and get a second property, and a third, and a fourth, and a fifth, and a sixth, and they still doing whatever they want to do in life. But you've benefited them by getting them on a path to being into real estate ownership, cash flowing properties. So what they want to be a scientist or whatever they want to do, they doing it because this is what they want to do in life. But you have ensured that they're going to be paid all the time. They'll never have these problems that you and I probably had of wondering how you're going to pay a bill. Wondering when the next job is coming. They won't have that problem no more because you did the proper tax planning ahead of time and the proper financial planning after that. So we're keeping these things in mind at all times. Tax planning is a part of financial planning, is what I mean. All right, back to the tax strategy. Give a financial gift to your spouse, kids, or beneficiaries. I said that. Up to $14,000 is what you can contribute as a gift. So again, if you made this large sum of income, hey, give the gift of 14. Just you moving it from, you be on the same page with them, but you losing control of the money. But if your family is a team and you, like I just said, you was on that strategy, like I just mentioned, that you're going to try to get this investment property from, well, you can donate it to a custodial account that you are still in control of for your kid. So you hire them and pay them up to $12,000. And then You can donate to them $14,000. That's $26,000 right there off the bat. So you do that for 5 years. That's $100,000 that you're not going to be taxed on, for one, that you are still in control of for the benefit of your own flesh and blood. Seemed like a good idea to me. All right. Other factors to consider when you tax planning is paying tax later is better than paying tax right now. So, that goes into play with, because having the use of your money is always better now than later. And it's called the time value of money and opportunity cost, those type of things. But especially when it comes to tax, there's no get back from the tax. You're not getting no benefit from that, except, are the streets in your city smooth? Oh, that's the only benefit you're gonna get, is the municipal conveniences that go with paying your tax, like fixing the roads, public transportation. So if you just want to give the government more money, that's on you. Tax deferral is what that's all about. You deferring tax, paying later. You want to pay the tax later. And so I see I'm running out of time, and so I'm gonna cut it there, and I'll just stop at start a business. That's my number one strategy for my clients. Is I encourage you to be entrepreneurial and start a business. But I don't know how. All right, we're gonna learn. You're gonna learn how. I'm gonna teach you how. I got courses for you. Take some of my courses. Well, they cost them. It don't cost them, but they're only hundreds of dollars, not thousands of dollars. I have investment programs that are $2,500, but that's an investment program that's going to teach you how to invest, and what comes with that is a financial plan as well. So, but that's part of that includes tax planning, but fundamentally start a business, and that is going to help fundamentally with your saving on your taxes. When it comes time to prepare your tax, to turn in your taxes at the end of the year. Also, back to the IRA accounts and the 401ks. Let's say you didn't do none of this, and then it comes time to comes time to prepare your taxes. And when you go to H&R Block, they can't help you no more if you didn't do it. But when you come to me, we can sit there. The rule is, as long as you open and contribute before the April 15th. So we can open your account sitting at the desk right now, sitting at a table, wherever we meet to do your taxes. Even if we're doing it online, over the internet and over the telephone, I can open your IRA account. You can still contribute your $5,000, $6,000, whatever, to your IRA account. That will reduce your taxes. So if you have the money sitting somewhere, why would you let it sit in the bank? Put it in your retirement account. I can open the account for you. Sit it in your retirement account, of which we're going to pick a portfolio of investments that's going to, theoretically, it's going to do good. We're not trying to pick no investments that are going to do bad, but we'll talk that out as well, and how to benefit when the market is up and how to benefit when the market is down. That's the type of investment strategy we're going to have. But the point is, we can open the account for you after January 1st. And the amount you contribute to your retirement account still counts for the previous year. So that's just another little tidbit. Reach out to me. Please like this video. Please share this video. Please subscribe to my YouTube channel. Please contact me if you need your taxes done. If you need tax planning, please, hey, I can help you. Don't pay more and receive less. Get on track to get right. So let's do it. Troy White with Hoodoo Financial. The website is www.hoodoofinancial.com, and you can email me at twhite at hoodoofinancial.com. Holler.